Back, Bob Pisani here. We are near the lows for the day. Dow Jones Industrial Average down about 800 points. Joining me right now, Burton Malkiel, Professor Emeritus of Economics at Princeton University, author of the legendary book, A Random Walk Down Wall Street. Professor, thanks very much for joining us today. I wanted to ask you about ESG, but I've got to start with the markets. You pioneered the idea that stocks tend to follow a random walk, but the markets seem to be reacting today very much to stimulus or the lack thereof and the reopening story. Can you give us your perceptions of what the markets might be doing going into the end of the year? What should an investor be doing right now?
Well, first of all, in terms of a random walk, the idea is that the market moves on news, and true news is something that you can't predict from the past. So the fact that we are now running toward a new peak in coronavirus deaths, and not so much deaths as basically diagnoses, and this was perhaps not anticipated. That's what makes markets move, and I don't think you can predict this, and I don't think it's possible to do that. What we know is that eventually we're going to have treatments, we're going to have a vaccine, eventually we are going to have stimulus, maybe not before the election, maybe not before even a new administration, but it'll happen, and basically investors should sit tight, because don't try to predict what's going to happen. You won't be able to do it.
Let me pick up on that. We debate growth versus value every day here. We debate small cap versus big cap. We debate momentum versus low volatility. We do this every day. Your central thesis is essentially that you can't beat the markets long-term, stay with index funds. Has anything happened this year that makes you change that thesis? Does any of this factor investing, value over growth, small cap over big cap, low vol over momentum? Is there any indication that that still matters long-term, or should you, as you suggest, basically still stick with index funds?
Absolutely, you should stick with index funds. Growth and value, for example, at the beginning of the year, so many pundits were saying value is cheaper relative to growth than ever before. And what happened is that growth trounced value. Again, you can't do it. There is, at some point, value is going to trounce growth. I don't know when, but at some point it will. And don't try to do it if you're in an index fund. You've got growth and value. You've got, if it's a broad-based index fund, you've got small cap and large cap. You'll never be able to predict when one is going to be in the ascendancy, and you're much better off to just be broadly indexed in a very low-cost index fund.
All right, Professor, we got to let you go. We got 20 seconds. You wrote an op-ed in the Wall Street Journal, very critical of ESG. That's a very big part of ETF investing right now. 20 seconds. Could you just tell us what your concern is about ESG right now? Because it's growing rapidly.
My concern is I don't know what's a good company and what's a bad company, and neither does anybody else. Is the utility that burns coal a bad company because it burns coal? Or is it a good company because it's doing an enormous amount of investing in wind power? Do I feel good about an ETF that basically has Facebook and Visa and MasterCard within the top 10 when they charge exorbitant interest rates to poor investors? I don't know that any ESG broad-based fund is really one that makes me feel confident that I'm investing in really good companies.